Welcome to the Cannabis Investor. We are your leading social media outlet for medical and legal marijuana investment opportunities. Today's topic, what makes the Canadian cannabis market different from America's? Let's find out. In order to draw an effective comparison between the two cannabis markets, we need to know where the broader industry has been, where it currently is, and what is likely to happen in the long term. According to experts, the cannabis market is now taking a breather after months of rallying to astronomical highs, which saw several companies quintuple their valuations. From what we have observed so far, once recreational cannabis use is approved in Canada, the whole market could be upended, with only a few viable players managing to actually make investors any money. To begin with, this can be explained by the fact that a huge number of cannabis companies are penny stocks trading on the OTC, which means that investors are taking on more risk for potentially higher rewards. For example, in the US, the government made cannabis a state's issue, which means that a state has to first decide to legalize cannabis on its own before going on to establish cannabis programs, while in Canada, cannabis has always been treated as a federal issue. Since marijuana is classified as a Schedule I substance in the US, researchers must receive approval from 3 government agencies, namely NIIDA, FDA, and DEA. While in Canada, they must seek approval for scientific exemptions from Health Canada for each compound of the cannabis plant that they intend to study. For investors hoping to profit from both medical marijuana and recreational sales in Canada, we recommend looking at Canopy Growth. Canopy Growth happens to be the country's industry leader in medical marijuana with 58,000 registered patients according to its most fiscal year 2017 financial report. For more context, the company basically doubled its patient numbers compared to the previous year as sales increased 203%. However, it announced a loss of $16.7 million for the year, but as Chairman and Chief Executive Bruce Linton stated, the aim is to be the best ready and the best positioned as 2018 hits. The company has been focusing on production rather than seeking profit, according to Linton, in order to prepare for a marijuana market that will be underserved when prohibition is lifted. For investors in the US, it is nearly impossible to find a single stock that can give you access to the market and positioning in the way that Canopy Growth does in Canada. For this reason, we recommend looking at Massroots. Massroots offers a unique way of tapping into the cannabis supply chain through its vast platform, since it doesn't actually handle the plant. With more than 1 million registered users, the company enables consumers to rate products and cannabis strains based on their effectiveness. In turn, using the platform helps other users make informed purchase decisions at their local dispensary. In addition to this, Massroots offers its software to businesses for a fee of $500 to $2,000 per contract. The company has in fact stated that it plans on expanding to 579 licensed dispensaries in Colorado and 40 in Alaska. Thank you for tuning in to this episode of the Cannabis Investor. We hope we introduced you to some interesting information to consider when choosing to invest between the Canadian or American cannabis market. Don't forget to follow our Facebook page for more videos, articles, and breaking news.